welcome to Market Domination. I'm Julie Hyman, Josh Schaefer in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
For January, we saw kind of a broad-based increase, especially for several durable goods like household repairs, supplies, and exercise equipment, as well as various services that are discretionary, as you mentioned, vacation-related services, restaurants, etc. But groceries, we actually saw a decrease in price sensitivity, which sounds kind of counterintuitive when you think about egg prices, but it kind of makes sense also because groceries, as you mentioned, are something that are essential for people to purchase. They need to purchase them anyway, even if they are running into higher than expected prices.
This idea of exploring digital assets and putting them on the balance sheet, which we've obviously seen, and I think you're seeing that now happen across the industry, and you're seeing positive reactions to that, kind of this reserve treasury strategy.
Moderna remains in a very challenging position. We have spoken about this in the past. We downgraded this stock, I think more than a quarter ago, talking about how revenue outlook continues to be very murky and the OPEX and spending continues to be so high and the cash burn is a problem. So the cash is $9 billion, going to $6 billion, going to $3 billion and downward, and there's really no visible path to profitability that we would see on the horizon.
We got 1 hour to go until the market close. So let's take a look at the major averages here. The Dow, let's say overall, first of all, little changed, right? We did have retail sales this morning that came in disappointing, capping off a week of some choppy data. The Dow down 121 points, about 0.25%. The S&P, little change. The Nasdaq up 0.25%. And there was a phrase that our friend Amy Wu Silverman of RBC spoke to us about recently. She called it the paddling duck is what the market is right now. In other words, things seem pretty calm on the surface, but underneath you have the feet furiously working.
There's a lot of market action happening underneath these indexes, Julie. And what's been interesting is we've sort of lost that mega cap drivers, right? A lot of those big tech stocks that give you the big gains that you'd see in the indexes. And instead, it's a lot of smaller stocks that are moving. I know if we move over to our trending tickers page here, we'll take a look at some of those bigger moves. But you had NVIDIA out with their 13F. They released that. Take a look at some of the top stocks here, right? So this is NVIDIA buying shares of WeRide. Stock's up about 78% today. At one point, it was doubled before the market opened. SoundHound, they sold shares. That stock also seeing a big move. So we're seeing big moves in individual names, but just not really in the index.
Exactly. Serve Robotics is another stock that NVIDIA sold out of here. WeRide, by the way, is a Chinese company. Nebius Group is another one that NVIDIA bought. So these are some of the moves, big moves we're seeing. Dell, by the way, reportedly getting a big server contract from XAI. So it's one of the ones that is on the trenders list too.
Yeah, and a lot of moves in tech and specifically in semis today, right? We've been watching that space a lot, and it's been interesting to see some of the different moves here. So potentially Intel, potentially working with Taiwan Semiconductor. We saw a little bit of a move in Intel when this report came out, Julie, but it didn't really seem to hold. So it'll be interesting to see how that plays out moving forward.
Yeah, we're going to talk much more about that report. But indeed, okay, so this is today, but if you look at the 5-day chart of Intel, it is a monster week for Intel, granted from very depressed levels, but we had been watching Intel climb, that there was speculation about some sort of partnership between Intel and Taiwan Semi on manufacturing in the U.S., and then that report today from Bloomberg saying that the administration has asked Taiwan Semi to get involved in some way. And I guess it was already priced in to some extent, right? And that's why you didn't have the stock continue to gain.
Yeah, it seems like the looming question right now for markets is what does the administration actually want to do with building out AI infrastructure in the U.S.? What levers can they actually pull? We know we've heard a lot about it, but how does that quite play out and who does it benefit? Does it benefit Intel? Does it benefit some of the other chip makers? Seems to be the question for now.
Yeah, I mean, it's a great question because the previous administration used the carrot rather than the stick mostly, right? The incentives involved in the CHIPS Act. This administration using tariffs and just brute force. I'm not quite sure, or asking these companies to get involved. I mean, there were some carrots saying, the president has said if you invest a certain amount in the U.S., we'll make things very easy on a regulatory basis. So, we'll see what all that yields.
Yeah, for now, it's at least helping Intel come off a pretty big bottom that's been on recently.
Indeed. As we talked about, it has been a big week of economic data. With the market digesting today's latest retail sales, we're looking at some of the biggest takeaways of the week. And for more, we're bringing in Sonia Meskin, senior economist at UBS. Sonia, we had today the retail sales that came in worse than estimated, but we also had a couple of hot inflation prints this week. Kind of where are we in terms of your thinking about the economy after this latest batch of data that we've gotten?
Sure. Yes, you're right. Retail sales could be very volatile, though, and there may be some seasonality there as well. Inflation did come in hotter than expected. I would say, though, and this is our general thinking here, that January has been, for the CPI specifically, quite seasonally difficult months to forecast, and some of this strength can be quite temporary. We do expect inflation to continue to decelerate longer term, but one of the areas that we're watching, for instance, to try to disaggregate the kind of temporary factors from the underlying trend is maybe a little bit too niche here, but food away from home, for example. And that category has been running just roughly at pre-pandemic trend more recently, and we would expect that to remain the case.
Sonia, did anything really change for the Fed story this week? After the CPI print, markets wanted to get ahead of themselves per usual, right? And markets start pricing in one rate cut instead of two rate cuts. Then you start looking at pricing over the last 2 days after the PPI report. Feels like we're kind of just back to where we started at the start of the week. Do you feel like the Fed narrative changed at all this week for what you're thinking about in terms of potential rate cuts?
Well, it's difficult for us. We actually did alter our forecast. We now expect the Fed to pause for a considerably longer period of time than we were thinking earlier in the year. And the big uncertainty here, of course, around everything you're trying to do when you forecast the Fed is what happens with fiscal policy. Does the deregulation that seems to be priced into markets right now, how meaningful is this impact going to be, if at all? And then the same with tariffs. How much is this really just, fundamentally news headlines versus what will get implemented on the ground?
And there's also the question of how inflation then affects tariffs, right? I've seen some reports, some analysis this week that because of the hot inflation prints, maybe that will constrain the president's willingness or ability to impose big tariffs. Do you all view it that way?
Well, we see actually, this is where we differ a bit from consensus. We see almost in all the simulations we do, is we see a bigger impact on growth than inflation. Not that we don't see an impact on inflation, but we also see an impact on growth. It doesn't seem to be reflected in the market. So this is one of our worries, of course, is that if we start introducing multiple and reciprocal tariffs, that the hit to growth will be, in fact, more substantial than people are currently thinking about.
And given, I know we talked about the volatility in retail sales, right? And there are several factors, maybe weather, maybe just fall off from the holidays. But where do you feel like the economic growth story is at this point in the consumer specifically? If we were to see tariffs weigh on economic growth, are we on solid footing where sort of we can afford to have it weigh on economic growth a little bit, or not so much?
Well, we're starting from a strong base, right? The consumer has really surprised all of us on the upside in the last couple of years. And really, we have a net worth buildup from a strong stock market that's carried the day further than we originally feared. So we're starting from a strong base, of course, but we all know that inflation does eat into anyone's ability to consume.
I want to talk about the job side of the equation also. And Josh helpfully flagging some jobless claims data from D.C., in particular, Washington, D.C. this last week, where we saw an increase because there are estimates about how many government workers are currently either losing their jobs or taking the buyout, however that works out. And government jobs have been a big source of growth. So how is this all going to affect the jobs picture?
That's right, and this is a downside risk, of course. Government jobs have been a source of growth. So if you're going to be losing momentum there, you would have to make it up elsewhere. And when you impose tariffs and you deregulate, there are winners and losers in any of those equations. And for example, you impose tariffs that help steel and aluminum producers, but you're potentially hurting those who use those materials as input costs.
I'm curious, we talk a lot about tariffs, right? And I guess maybe because we haven't gotten to the full deportation story yet, but we're talking about risks to the labor market, and it seems like you feel like there might be more risks to growth in the labor market. So how does deportation also fit in? Like, is Trump policy, I guess, perhaps more of a risk to growth in the labor market overall than it is for inflation?
It could be, but it also, say we shrink labor supply, we're then going to effectively affect the price of labor on the upside. And that could potentially be a lot stickier than just the goods prices, which is really a global market.
So when you look at GDP this year, what are you all targeting? And do you think that consensus is too optimistic?
We do believe that we're effectively going to be slowing to trend, both in the jobs data and ultimately in the GDP data. And that hinges a lot on the slowing consumer, not falling off a cliff, but slowing to trend.
Where do you see the consumer slowing down? Where does that sort of happen? I feel like we've been waiting for the consumer slowdown, right, for the last 2 years, and it just hasn't quite fully materialized. What pieces of data do you feel like you're starting to see that in that you're watching?
Well, we do see the lower income, lower wealth brackets, actually the savings obviously are getting eaten away. And with the job market not expanding, not falling off a cliff, people not losing jobs, but also we're just kind of trending water here, right? So that increases the risk on the whatever downside risks there may be, increases the vulnerability. And of course, listen, for the higher income consumer, if the stock market were to get hit, there's going to be a downward wealth effect.
All right, Sonia, good to see you. Thanks for coming in. Appreciate it. We're just getting started here on Market Domination. Coming up, NVIDIA disclosed its latest equity holdings, and the reveal led to some wild swings for a few tickers. We'll get you caught up on all those moves in the chip sector on the other side. Stick around, much more Market Domination still to come. There's been a few shifting pieces recently in the chip race as companies fight for a spot on the chip sector leaderboard. Taiwan Semiconductor reportedly considering running Intel's U.S. factories, according to Bloomberg. Intel shares pulling back from a jump earlier in the week where U.S. Vice President J.D. Vance highlighted the importance of U.S.-based chip makers. Here with the latest on what's ahead in the semiconductor landscape, Baird Technology Desk sector strategist Ted Mortensen. Ted, it's really great to have you here because we keep getting these headlines fast and furious today. The latest, a report that the administration has approached Taiwan Semiconductor about this stake partnership, what have you, with Intel and Taiwan Semi to manufacture chips in the U.S. What do you make of that?
Well, Intel's somewhat of a sinking ship right now. They're having a lot of trouble on their 18A foundry node. They just cannot, along with Samsung, they're really having trouble at the 3-nanometer range. Now, you take TSM, which is, I would say, the gold-plated area of manufactured at these advanced nodes. They're already manufacturing in volume at 3-nanometer. They've cracked the code at that node, and they're really moving to 2-nanometer, which is the magical node. And the reason why they have such an advantage is that at 2 nanometers, you get about 15% better performance and about 30% better power profiles. And when you talk about Gen AI, you need to be there, and Intel's not. So in some respects, the administration's move here is not unexpected. Intel's a national asset, not only from a security standpoint, but manufacturing in the U.S., and they need some help, and TSM's the only one that can render the lifeboat.
Ted, is it enough for Intel, though? I mean, you call it a sinking ship. Would this be enough to, I guess, plug the holes in that ship?
Well, they got to get rid of foundry. I mean, it's kind of a boat anchor on their profitability. If they get the 18A node to work, at least they'll be on the same node as AMD is. AMD has significantly beat Intel up, both on the client and the server side. The server side is where they really need to be at that next generation node because of power, and that's where all the gross margin is. So if they can get help on foundry, if you look at Intel's foundry, their largest customer is Intel at the server level, which again carries that high gross margin. They got to get it right, and they're just not there yet.
Ted, is a potential for either a stake sale, partnership, whatever it is, with TSM, is that a reason for investors to own Intel right now? It seems to have been this week.
Well, I think the weightings when I talk to portfolio managers, the weightings are very de minimis. So you're really looking at a valuation play. And if you look at the call options that were done early in the week, they're roughly at the 25 level. This would dramatically increase, I would say, Intel's valuation of getting rid of that foundry business. But TSM is not going to do it for free. The Trump administration has to negotiate a deal with TSM that they get preferential treatment, not only on if they do buy the foundry at the price they can buy it at, number one, and then an earn-out provision. They're not going to give up the sacred cow of their IP at the 3 and 2 nanometer range. They're just not going to do it. It really puts their model at risk if it's not structured the right way, that they truly profit from that combination.
Ted, I want to shift gears to another company here. A report out earlier this week that ARM will be launching a new AI chip with Meta as a customer. Curious what you just make of that headline, that report. Is that something that you think overall makes sense for ARM? Are they going to be able to compete in that AI chip space in that way?
It's a great question, too. I mean, ARM's late here. They're a royalty company that companies contract with on the royalty basis for their designs. Their designs are fantastic. I mean, if you look what's happening on the PC and also on the data center side on Gen AI, a lot of these designs are ARM-based. Now, the problem, though, is that they are late. NVIDIA is years ahead of them as it relates to an integrated silicon solution, whether it be networking, whether it be memory, whether it be GPU and CPU. That's going to be a very tough nut to crack. if ARM is going to be successful, they're going to have to be 20 to 30% better than any other chip out there. And that's a tall order. The other thing is they are now directly competing with their customers. And that would be Amazon on Trainium and their inference chip, Microsoft, Meta. It's interesting that Meta is going along with ARM, and also Google. I mean, a lot of these designs are ARM based, and if ARM gets into the fray here, they're going to be a direct competitor, not only with Qualcomm also. So I don't think it's that clear, and I don't think it's, quite frankly, there's a lot that we don't know, and from a P&L standpoint, they really don't have a choice. They've got to get in the semi-IC space.
Ted, I'm curious your take more generally on kind of where we are in this Gen AI investment cycle. Obviously, we've just got a lot of big announcements about big numbers that the hyperscalers are spending. But you don't sound very enthusiastic, certainly, about some of these chip makers. The market, doesn't feel as enthusiastic right now. What do you think?
Well, take a look at the Microsoft chart, or take a look at some of the cloud titans. They've kind of gone sideways for a while, and I think what's happening in the Gen AI area, it's one of the biggest technologies in our lifetime. We're just spending a ton of money, and there's been some advances not only on the silicon side but the software stack, where if you look at where training pricing and especially inference pricing, if you listen to the Palantir call, it's the second quarter that they basically said that inference pricing is imploding. So it's getting cheaper to run these models, and until we baseline and see really what the model is, the unknown is how much these cloud titans are spending. I mean, we're up 50% in cloud spend, over $200 billion for the big four in 2025. That's an astronomical number. And I just think for AI really to get going, we're going to have a digestion phase, and then the market will really, really pivot up to the upside.
Ted, we've talked AI chips for 5 minutes here, and we haven't really talked about NVIDIA. I can't let you go without asking you about it. Overall, where do you feel like sentiment is at with that name, and to sort of what you were talking about there? Are we sort of at fair price at this point, and it feels like maybe NVIDIA needs to start doing something a little bit, we need to see a little bit more over the next couple quarters? Or how are you sort of feeling about that name that I'm sure you get asked about quite a bit?
So there's a lot of open questions on NVIDIA. From a retail perspective, this is a very, very lazy long, and in some respects, a retail investor is taking a knife to a gunfight on what the institutional investors are looking at. This quarter is going to be very interesting, and the reason why is NVIDIA is going through an architectural shift from what's called the old H100, H200 GPU architectures to Blackwell. And there's a server called the GB200, without getting too specific. This is a copper-based backplane server that NVIDIA introduced and was supposed to take off. In reality, what we're finding through our research is the hyperscalers want more of this optical solution that's associated with the B300, so they're waiting. And if the hyperscales are waiting on this infrastructure transition, NVIDIA is going to be forced to sell more Blackwell standalone GPUs. That will put some pressure on gross margins. To what degree, we don't know. And if you look at the January quarter coming up to be reported in a couple weeks here, a week and a half or so, that comp is up 72% year over year, where the street is right now. We just have to see them exceed that very difficult comp. And then where the institutional investors are really, really focused is kind of seeing the actual print for April. If that exceeds, then I think you're going to see NVIDIA move up and past the 140 level. But there is some real big focus on this transition infrastructure discussion and also gross margins on how that April guide comes in. That's what everybody's waiting for, is that April guide.
Well, in the meantime, of course, we'll get those earnings on February 26th and see if we get some guidance and how that looks. Ted, thank you so much for your perspective. Appreciate it.
Well, have a good weekend. Thank you.
You too. Thanks. Shares of Dell rising as the company reportedly nears a deal with Elon Musk's xAI, according to Bloomberg. This would, Bloomberg saying, mean $5 billion in servers for xAI. For the AI work that it is doing here. And actually, we were just talking about NVIDIA. Apparently, these servers are going to contain some of those NVIDIA GB200 chips.
Yes, Julie, and it's interesting to me, I think, just zooming out on sort of that Dell chart and thinking about what has been priced in, then priced out of this stock and sort of where investors have wanted to go with it over the last year. Dell hit an all-time high in May or June of last year, and the stock had ripped about 100%, I think it was at one point over a couple month period, as investors really got bullish on what Dell was doing with AI. And then it felt like most analysts on the street came out and said, okay, we like what Dell's doing in AI, but not that much. And we might have gone a little far, and the stock has been a little bit quiet since then, so seems like positive news in that sense.
I mean, there's also a realization that people have come to with a number of these different names that, like, yes, they're doing some AI stuff, but the majority of their business is still the other stuff that they do. Yes. And even if this is the biggest growth part of the business, like, how much will it actually be material, and what is the growth going to look like in a sustained way? So.
No, it's a great point. I feel like we take every company and try and make it into NVIDIA when we talk about AI, right? Because that is now NVIDIA's business, right? Is selling AI chips. And when we talk about other companies that are involved in the space, Dell still makes computers too, and they still sell them to us. They do plenty of other things, right? They do tangible things that we know. So it's a little bit more than AI. I agree.
Well, speaking of NVIDIA, let's keep talking about it. The company reshuffled its investment portfolio Friday, cutting its stake in ARM Holdings by 44% while exiting Serve Robotics and SoundHound AI altogether. The company also picked up a stake in self-driving startup WeRide, which is Chinese. It added 1.2 million shares in AI cloud firm Nebius. So how should retail investors view all of these moves? Joining us now is Tom Sosnoff, Tasty Live CEO and founder. It's really good to see you, Tom. You know, I've been doing this a while. You've been doing this a while. We look at 13Fs. We try to get clues as to what big investors are doing. Usually, those big investors are not companies like NVIDIA, right? So how should people be, you know, and people in the past like would look at Buffett's holdings and try and follow that. Is this something people should be looking at, and are they looking at it as sort of a template?
It's hard for me to say because it's not our style. I mean, we're kind of hardcore quantitative traders, and so we don't think of, or at least I don't think of, fundamentals when it comes to buying and selling or trading derivatives around any of these plays. So it would be very difficult for me to sit here and say, hey, you know what, I have to think of it as an investment portfolio. I think of it as a trade. And in NVIDIA's case, you know, I think of a stock that's been up, 10 straight days now. And, you know, I just think of pot odds and velocity of risk and things like that. And when I look at NVIDIA, I think of it as maybe it's got a little more downside risk than it has upside potential. I don't think beyond that.
Tom, I'm curious if you think at all about if you were owning one of these stocks that's either owned by NVIDIA, or if you were owning a company like NVIDIA that owns a bunch of other stocks, how to think about that as an investor. If I owned SoundHound and I know NVIDIA has a position and a 13F could come out when they come out, and then the stock just tanks 30%, is that something that people should be wary of, and how do you sort of assess that?
As a trader and as an investor, I think it's really important that, and I've been doing this a long time, like into my 5th decade, you have to focus on the things that you can control. And what you can't control is what some company may or may not do with their stock holdings. Like, you can't fall in love with a play because you think some company is going to invest in another company or some company is going to stay invested. You have no idea what they're thinking or how long they're going to be in there, or if they're putting up a print, or if it's just a show or whatever it is. So you got to be very careful with that kind of, if you don't like the company, then you shouldn't be in it passively. If you like the company for a trade, whether it's either long or short, that's completely different. But if you're making a long-term passive investment, you've got to do what you can control with respect to that trade, which means you buy the stock, you can lower your basis or improve your basis by selling something against it. But there's not much else, you know, you can't control what some other company does. So you can't think about that. That's not a reason to make an investment.
So let's talk about, I guess, the trading side of it and the sort of tactical side of it then, Tom. You know, when you see this kind of 13F come out and people are chasing not just NVIDIA itself, but trying to, chase the other
Yeah.
plays it's making. Is
course.
that a good strategy to take?
No, it's actually, we're contrarians. So, we would take the exact, it's a good strategy to jump into the game at that point, because when news comes out and volatility goes higher, that means there's an opportunity there. But for me, the opportunity would be to, that's a classic buy the rumor, sell the news. And I think in those cases, when you see a stock that shoots up on somebody else's news, and you have to kind of wonder about the integrity of that news, then I think it's much more of an opportunity to sell into it than it is to buy into it.
Tom, I'm curious what you make of just the size of the moves that we saw in these stocks today, and maybe perhaps what that says about the market that we're in right now.
We're in a market that is flush with a lot of liquidity. And this isn't something that's happened in the last couple of days, weeks, not even the last couple of years. We have been really just swimming in liquidity for quite some time now. And so the amount of money movement, if it was 10 or 20 years ago, it would surprise the hell out of us. But what we're looking right now is kind of, we're almost getting used to it just because there's so much liquidity sloshing around there. So does it still kind of surprise me and shake me up a little bit? And the answer is, of course, just because the numbers are absolutely massive. But maybe we're becoming a little immune to the numbers just because they're so huge. So it doesn't surprise me. I don't know if we ever get used to it at these levels.
Yeah, another example that we've been watching over the past couple of days is with GameStop, right? Where first we had Ryan Cohen tweeting a picture of him and Michael Saylor. Then there's this reporting that GameStop is exploring investing in crypto in some way. What do you think?
These are the kind of things, this is a little different. These are more the things that, for me, those are the things that creep me out, not get me excited about it. Those are the things like Ryan Cohen's little game there. That's way more creepy than it is interesting to me. I think the NVIDIA stuff is much more real. And when you talk about, just what's going on in the tech space and all the games they're playing, I think that stuff's real. The GameStop stuff, it's a little late to be jumping on the Michael Saylor bandwagon at this point. And so, no, I don't like that play at all.
Why do you think, though, that there are still, for lack of a better word, Ryan Cohen fanboys out there who are following, those kinds of headlines still? Or do you think that they're just trades and it's not necessarily that sort of faith in him?
Exactly. I think it's faith in, it's much more faith in the opportunity that he presents. Like people, including myself, love people that can go in and mix up markets and create volatility, which then creates opportunity. I don't really think it's people that actually believe Ryan Cohen or actually think that, that means something other than they believe that there's other people out there. It's kind of like a greater fool theory. And it's more of, I don't like it because it's very much a smoke and mirrors game, and I'd be very careful about that. But I think what Ryan Cohen does, he shakes things up. And I think for traders, that's, it's better than watching paint dry.
Tom, I'm curious what you make of, just generally speaking, Saylor's strategy that he's done with what we call now strategy, right? But the buy Bitcoin strategy is something that other companies have talked about potentially doing. Maybe some companies would do it with their cash. That's clearly the speculation here, I think, that the market's making of what GameStop would do. Is that a trade that one can chase, or is strategy gonna just be strategy and they're the only company that ever did that?
You're gonna have to book me for about 45 minutes if you want to have this conversation because I've written about it extensively. I've talked about it for hours online. I'm very opinionated on this subject. Just because I know we're short on time, my simple answer for me is, would I invest in micro strategies or strategies? And the answer is not with your money. Would I trade it? And I do almost every single day. So I have two sides to that. I trade options and stocks and everything else in MicroStrategy all the time because it's liquid and because it's volatile and it moves around and it's a great trading vehicle. I wouldn't buy it under any circumstances. I absolutely despise the model.
Interesting. Tom Sosnoff, appreciate it. We're going to have to leave it there.
45 minutes
guys.
next time, Tom.
All right, stick around. Much more market domination on the other side. The rally is broadening, and recent moves in sectors such as healthcare and financials have shown there are plenty of opportunities for investors beyond the Magnificent Seven. For more, we want to welcome in Phil Orlando, Federated Hermes Chief Equity Strategist. Phil, let's start right there. It seems like there's actually some moves to make in this stock market that are not just buy big tech and forget about it like it felt like it was for the last 2 years. Where are you seeing opportunities right now?
No, Josh, you're exactly right. For the better part of the last 2 years, it was, the Mag 7. That was the entire story in terms of driving S&P 500 performance. But in our view, those stocks got ahead of themselves from a valuation perspective. And I guess since the middle of last year, our view is that we were going to see a broadening out of that rally. There would be a reversion of the mean. And as part of that, there would be a pretty significant catch-up trade in which the categories that, frankly, had been left for dead would finally get their moment in the sun. That would include, domestic large-cap value stocks, small-cap stocks, both growth and value, and international stocks with an emerging markets focus. So we're overweight equities. We've been overweight equities for the last couple of years now, but we've got more of a neutral position on growth and technology. We think it's these value stocks and the smaller cap names and the international names that have started to play catch up over the last couple of quarters, and we think that trade has legs.
I'm just taking a look, Phil. Hey, it's Julie. I'm just taking a look here at some of the groups that are the best performing in the S&P this year. Communication services still number one, but financials, materials, consumer staples are gaining some ground against it here, and they've all outperformed the underlying S&P 500. So, it does feel, though, a little fits and starts, right? It's not like that there is this clear one-to-one rotation, one in, one out kind of thing. So how do you think that sort of plays out as the year goes on?
Well, I guess if it was easy, Julie, we'd all be, sipping pina coladas on an island somewhere. The reality is that this is a long cycle game, and as the cycles are starting to play out from a sector standpoint, we felt that financial services, healthcare, industrials, and utilities were the ones that were the most left behind, but yet the underlying fundamentals of those sectors we thought were very strong. And at some point, the market would begin to appreciate the fact that you had, really good underlying fundamentals with good earnings growth, yet the valuation just hadn't caught up. And all of the momentum had been in those 7 names, the Mag 7 names, which account for about, roughly a third of the market cap of the S&P 500. So, I've been doing this a long time. Maybe unfortunately, I was seared by the memory of what happened in the late 90s as the technology stocks had a phenomenal run going into helping to solve the Y2K calendar changeover problem. And those technology stocks continue to do well for another month or two into the beginning of 2000, and then much like the coyote running off the cliff with the roadrunner, investors at some point realized that there were a lot of stocks that were cheap, and the technology stocks had gotten ahead of themselves. So that was the environment that we thought we were looking at a couple of quarters ago. So we've been positioned that way accordingly.
Phil, I'm curious though. You still have a 7,000 price target for the S&P 500, I believe. How do we get there if we don't have large cap tech sort of driving these outside gains, right? That's still a 20% gain on the year. I talked to some strategists that say you're going to get the broadening of the rally, but you might get a more normal return, right? Maybe something in a 7-8%. How do we still get such a big rally for the index if we don't have large caps doing a lot of lifting?
Certainly. So earnings very clearly are the story here. And if you look at what's transpired in the market over the course of the last couple of years and what we think is going to play out over the course of the next couple of years, the earnings growth of the Mag 7 names peaked out at about 60% year on year about 5 or 6 quarters ago. And then in the first quarter of last year, it slowed to 50%. And the second quarter slowed to 40%. So there's a deceleration going on in the earnings growth that we think by the end of this year will be somewhere in the 15 or 20% neighborhood. That's not bad, but it's not 50 or 60%. At the same time, the rest of the market, the forgotten 493, which a year ago was posting negative year-on-year earnings, those earnings are starting to come back, and we think that by the end of this year, that earnings growth will have gone from negative to something closer to, let's call it 10 or 12%. Again, not phenomenal compared to the Mag 7 names, but directionally in much better shape than we were a year ago. The market hasn't fully priced in that rotation, if you will. So as we play that cycle out and then overlay on that the fact that we've got, a new sheriff in town in Washington with different fiscal policies, reduction in regulations, increased exploration and production in energy, tax cuts, all of those things, as they play out over the course of this year when they're implemented, they will start to have a positive impact on economic growth and corporate earnings growth in 26 and 27. Right. So in calendar 27, we expect that we'll get to about $350 in earnings for the S&P 500. You discount that back to next year, and we've got a 7,500 forecast on the S&P. Discount it back to this year, that's our 7,000 target. And discounted back to last year, our target was 6,200. The S&P got up to 6,100 at the end of the year.
Right.
So we think we've got this thing figured out. Now we've just got to see if the Trump administration can actually implement these plans and if they actually work.
Right. Well, those are big ifs, and we'll be checking back in with you to see how it plays out. Thank you, Phil. Appreciate it.
Thanks, Julie. Happy Valentine's Day to you.
And to you.
Thank you.
Now time for some of today's trending tickers. We're going to start with Goodyear Tire and Rubber. The shares surging after it beat Wall Street's estimates on the top and bottom line. Goodyear planning for EBITDA growth and debt reduction to improve its net leverage. The shares up by 18% today. And I saw some analyst commentary around the company's cost-cutting efforts, that's been something that's been helping out.
Yeah, it seems like that's been something that's been helping out Goodyear. And the other thing, too, Julie, that I thought was interesting, a lot of tariff talk on this call, and essentially management team saying they don't have a lot of answers yet. And I thought that just sort of spoke to the broader sentiment it seems like we've been hearing for overall in this earnings season, which is we have a plan if the tariffs get implemented. Right. We feel like we've managed well for it, but is it fully in the guide and fully in the what is being expected, at least from the market at this point, if they do get tariffs in Mexico and Canada and there's wider exposure? Just seems like a question that's a little bit remains to be seen, but it was interesting just to watch tariff talk sort of play out on a call, I think.
Right. Yeah, definitely. I mean, Bloomberg Intelligence talking about raw materials costs that already are rising for rubber, synthetic and natural rubber. And apparently Goodyear says it's going to be $175 million in the first quarter of those higher costs. And then, you throw on tariffs. I don't know if rubber specifically is going to be tariffed, but still, if there's tariffs on other things that affect it.
Right. Costs overall going up, usually a challenge.
Indeed. All right. In the Yahoo Finance podcast, Financial Freestyle, host Ross Mack discusses wealth-building journeys and what it takes to create a lasting financial footprint. You can scan the QR code below to stay up to date with all the latest with the podcast, and be sure to tune in to Financial Freestyle every Monday at noon Eastern. Here's a clip from the latest episode.
Is there kind of a steadfast rule that you could give where it says, if you're able to afford this in rent, you could actually purchase a home?
I think if you're able to afford more than $1,500 a month in rent, you should buy your own home. I think you should find a comparable place to where the one you're renting, get into it, and then over time build equity. You can then use it, you can upgrade from there. You can use it in an investment property. When rates come down, you can refinance it and rent it out to somebody else. Those are things that you can do with the real estate, so you don't have to feel locked in the same way, right? If you treat it like, yes, it's my home, but it's also an asset. And I think that's where people sort of have trouble kind of separating the two. Yeah. And, but if you do that, you have a lot of flexibility and a lot of optionality that I know regular folks have a hard time understanding the value of optionality, but there's a ton of optionality because you get to keep all the upside, the interest rate stays the same.
It's been a bumpy road for Tesla recently, but the stock has attempted to turn it around in the last couple of days. If shares can manage to finish higher today, it will be 3 consecutive gains following a painful 5-day losing streak that sent shares down more than 16%, and a losing streak, by the way, that started kind of in mid-December after the shares reached a record high. Joining us now, Brian Shannon, Alpha Trends founder. Brian, we really appreciate you being here because I know a lot of technicians like you have been digging into Tesla, looking at the sort of momentum, both to the up and the downside. What is the story of the chart on Tesla telling you right now?
Yeah, hi, Julie. Thanks for having me here, too. We're 30% off the highs, so that's a significant correction, obviously. A lot of people say, 20% is a bear market, so you could qualify this as a personal bear market for Tesla, while the market itself is making an all-time high. What we have going on here, though, is a pattern of lower highs and lower lows, and we're still, despite the third day up this week, we are down. We closed last week at 361, so we're down a couple percent this week, and unfortunately, the trend right now is a pattern of lower highs and lower lows. So I think you've just got to be a little bit cautious and a little bit more patient with this name. Maybe longer term investors are, nibbling at it slowly for a dollar cost average. But I think there's still reason for concern here.
Brian, any idea how far you think it could fall and what sort of support levels you're looking at to the downside?
Yeah, Josh. When I look at a chart, I look at the anchored volume weighted average price from key levels. And in August of last year, we had a significant low. And from that point, that's where this rally really took off from. So the anchor from that is at about 315, 310 right now. So if we continue lower, then I think that's the level where it's likely to find a more sustainable base of support.
And what would you be watching that would get you more constructive on the stock? What kind of levels or what kind of action?
Yeah, great question. As I said, we have this pattern of lower highs and lower lows. So we're stair-stepping down. I think the key level to watch on the upside right now is at about 385. 385 is the anchored volume-weighted average price from the election. And that's when, the stock really rallied from that 280-ish level up to the record highs you just mentioned. So that is a level of price memory. And we have a declining 20-day moving average in there as well. If 385 is hit, I think you've got to watch it very carefully up there. If it starts to fall from there, then it's highly likely that we will continue down towards that 310 level. But if we can jump above there and get a little bit more constructive, then I think we're becoming more neutral and we can start thinking about how the stock can, create a more sustainable, constructive base for a sustainable move.
Brian, I'm curious. This is more of sort of a general technical analysis question.
Yeah.
When you're looking at the chart patterns, does it matter the size of a company, right? Or, the general volatility of a company like Tesla, which is very large and can be unusually volatile for a name of that size. Does that play into it?
Well, that's a great question, Julie. I mean, technical analysis studies the behaviors of all the participants and their supply and demand, how it's reflected on the tape. So when we look at Tesla right now, we previously had a pattern of higher highs and higher lows, and things were good. Now the pattern is lower highs and lower lows. So if you just think about it from the most basic definition of trend, and when we look back to the high from December, we've been showing a pattern of lower highs and lower lows. That means that the sellers are, for now, on that time frame in control. Doesn't mean they're going to maintain control, because if you back it up to a much longer term time frame, you'll see this is just a pullback in a giant uptrend. So it's a matter of defining your time frame more than anything. But technical analysis will work on any instrument on any time frame. That's the beauty of it.
So Brian, to clarify, as you move time frames there, right? If we look at a short-term time frame, right, and we can see different trends, then if we move it all the way out, would that be sort of advising how long I'm looking to hold the stock then? If I'm looking at a longer-term trend, would I then be looking to buy and hold for longer, or is that not? Do those two not match up in that way?
Yeah, so a day trader has no business looking at a weekly chart really, and a investor really has no business looking at an intraday chart, they just don't, it becomes noise at a point where how important is a price level from 4 years ago to a day trader, that's not going to matter, even a swing trader. But for an investor, you might look at it and frame it in those timeframes based on your definition of trend for that time frame. So, yeah, excellent point.
Brian, really interesting stuff. Thank you so much for joining us. We appreciate it.
Thank you, Julie.
Take care. Evercore is upgrading CRISPR Therapeutics from inline to outperform. The note highlighting key catalysts that could usher in a new era for the company, and most of that has to do with products. Now, this is a gene editing company. It develops treatments based on gene therapies, right? And so the biggest thing that investors have been waiting for is Casgevy, which is a sickle cell treatment that is sort of in the launch process, if you will, this year. But there's some other drugs that the Evercore is looking ahead to also.
Yeah, it seems like overall the street, not just Evercore but beyond, is feeling like this could be the year for CRISPR, that we start to see some of these products actually come to market, and then we have a better idea of sort of what the overall trajectory is. I was relatively surprised for a stock that has just not performed well since 2021. When you zoom out on this chart, it has not done well at all. Street relatively bullish. There's 18 buys, 13 holds, and a price target of average price target at $82 a share, which is quite a bit higher than what you're looking at on your screen at 50. And I was reading analyst commentary from the team over at Citi, and they said they feel like there's several catalysts in the pipeline for 2025, basically laying out that they feel like most of the catalysts are not priced yet. The risks are priced to the downside.
Yes.
The upside risk has not really been accounted for, so perhaps maybe just room for good news to move the stock higher.
We'll see. It's down almost 40% over the past year, and as you said, down over the past couple of years. Yeah. Well, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery in a moment to get you up to speed on the action from today's trade. I'm going to start with where the major averages ended the day, and that is lower, in the case of the Dow at least, down by about 0.4%, about 166 points. The S&P 500, very little changed here, just a lot of bouncing around in a narrow range today. The Nasdaq up by about 0.4%. A lot of different cross currents, a lot of news crossing throughout the afternoon, reporting on the tech industry specifically, and so that could have been helping tech shares in general. We had a retail sales report this morning that was below estimates, but a lot of economists writing that off to seasonality, between fires and storms that were happening in the month of January, perhaps that putting a little bit of pressure. December numbers did get revised higher. And then if you look elsewhere as well, one of the things we want to point out, the S&P 500, very, very close to a record high of around 618, but didn't quite make it there today. And in fact, just ticking lower in the last moment there. The Nasdaq 100, though, large cap tech, for all the talk of broadening, and we continue to have all the talk of broadening, the Nasdaq 100 closed at a record today. Jared's got a closer look at what went on today.
Yes, I guess you're going to let me say it here because we're talking about concentration and all this good stuff. Meta, 20 straight days in a row to the upside. We'll take a look at that in a second. First, want to point out the Russell 2000 also in the red here in addition to the Dow. So we haven't seen the Mag 7 really participate that much in terms of the concentration risk that they had in earlier parts of this bull market in years past. But maybe today is a turning point. Haven't seen it this year so far. Communication services, though, speaking of records, that sector, XLC, closed at a record high today. And guess who's a member of that? That would be Meta. Before I jump over to that, let me just say that healthcare and staples, consumer staples, were both down more than 1%. Those were the two laggards there. And then here's the Nasdaq 100. As I said, Meta up 1.11%, 20 days in a row, 16 record highs this year, and the year-to-date percentage is now 25.82%. Will this stock ever go down? Most certainly, but we don't know which day. Apple up 1.25%, Nvidia up 2.6%, and that's getting pretty close to its record as well. We haven't said record high in Nvidia in a little bit, but I believe that's what we're looking at right there. As you can see it on the 3-month chart as well. It's just been going sideways for the most part, dipped down here below that range. So all in all, it was a productive week in a lot of senses. We came off those CPI lows. China has been one of the greatest beneficiaries of the risk-on rally to the upside. It was the leader this week as well, but also unprofitable tech. So lots of it, ignore the big one there, but lots of profitability here for unprofitable tech, at least in terms of the return. Not sure that made an entire big amount of sense there, but I hope you know what I'm trying to say.
A productive week it was, Jared Blickery. Appreciate you breaking that down for us. All right, a muted day on Wall Street, but for the week, the major averages posting solid gains. The S&P 500 also hovering near a record high. But our next guest is raising concerns about valuation. Joining us now is David Bahnsen, CIO of the Bahnsen Group. So David, when I just referenced valuations, I don't know if I'm necessarily talking about the market overall, but perhaps one area of the market where we're talking a lot about valuations right now, big tech, right? And sort of that Mag 7 trade. How are you sort of thinking about Mag 7 versus the rest of the market, and whether Jared was breaking down some versions of broadening out we've been seeing. Are we going to keep seeing the broadening out, or is the Mag 7 trade going to be the leader in 25?
No, I think you're going to see more broadening out, but it really is impossible to separate the story about the valuation issues with big tech and Mag 7 from the overall market because of the very concentration issue that many of us are talking about. In other words, if the top 5 to 10 companies of the S&P 500 made up, 12 to 18% of the market, it's a very different story. When it starts making up 30 to 40% of the market, and you essentially have 10 companies that are 40% of the S&P 500 and 490 companies that are just 60%, that makes the valuation story a market story because it has permeated this broad cap-weighted indexing so much.
So what then is the risk here, David? I mean, and we should mention, of course, we've been having this conversation for a while, right, about this concentration, about valuations, et cetera, and nothing really has meaningfully changed.
Well, those are very dangerous words, of course, because nothing had changed in 98, nothing had changed in 99, and then a whole lot of people felt a change in 2000. I agree with you completely that you don't know about the change until it happens, but history isn't really ambiguous about this. There will be change, and I don't think timing it is possible. I think being sensibly balanced going into the change, which is inevitable, is the right thing to do. And companies trading at 80 times earnings revert to the mean. I don't think that the risk is so much that there's going to be an immediate violence like the 70% drop in the Nasdaq of March 2000 that lasted for 15 years. I think it's going to be a repricing to some normalcy that a lot of these investors don't know can happen. They've never experienced a real drawdown. Anyone who's been invested in this space for 2 years, 3 years, they haven't seen it. So I think that's the risk, is that there will be a reality check for a lot of people, and yet I don't believe that the entirety of the market is overpriced. I think a lot of the more defensive sectors are very reasonably valued. There's good cash flow growth, there's good profit growth, and where there's reasonable valuations, the risk-reward trade-off is much more attractive.
Well, David, sticking with the ones where there are high valuations, so if there is going to be, or I should say when there is going to be, in your view, this repricing, what are your top contenders for what could trigger that repricing?
With NVIDIA, it could very well be fundamental because of order flow declining. It also could be margins having to inevitably come in. I happen to think both of those things are going to end up happening at some point. All it takes is 1 quarter of Microsoft, Amazon, or Google announcing that they're ordering less from NVIDIA, and the kind of virtuous cycle that has driven that space becomes a negative feedback loop. But it also could be that order flow continues and yet margins inevitably come down. I don't think anybody has ever seen a tech story presume expansion of margins like this. It is inevitable that margins will compress. And those are two stories that could be fundamentally catalytic, apart from the fact that just the valuations itself could correct. People should understand too, NVIDIA was down 26% a couple weeks ago from its high. It's more or less treaded water for 6 months, and we've been in a robust bull market. So I don't think that this is necessarily hypothetical. NVIDIA has already been a big laggard for the last 6 months, but it's up huge over the last year, 2 years, 3 years. So there's no reason to think that the pain has come yet. But already you see some of these things slowing down. You had a good January in markets, and yet I think 6 of the 7 Mag 7 names underperformed the market. I don't think this is anything outlandish that I'm predicting here.
David, I want to talk tariffs for a second, because it's a question we keep asking ourselves. We have people asking us, right? What does all of this sort of mean for the market in terms of, are we going to get full tariffs? Are we going to get no tariffs? Where do you think it sort of lands? And I guess really perhaps the more direct question, what do you feel like the market's pricing in right now in terms of tariffs, and where do the risks lie on either side?
Markets cannot price in tariffs that don't happen. And so to have the Dow up 350 points yesterday and the S&P and Nasdaq each up over 1%, because instead of getting an announcement about a bunch of reciprocal tariffs, we got the memo ordering people to study the idea of asking questions about one day getting back to us to report on tariffs. Okay, markets are not going to price in committees and questions and studies. So I believe 2 things are true right now. I'll say them quickly. I think that the president loves talking about tariffs, and I think the president does not love doing tariffs. And markets right now are pricing in both of those things very well. It could change at any time. But so far, whether it's negotiating deals with Mexico and Canada, whether it's setting the stage for some other kind of cosmetic victory here, or even a substantive victory there. I think a big master negotiations underway with China that could involve currency, IP theft, other issues. There's a lot going on, but none of it involves tariffs actually being imposed.
And so the market keeps on rising, more or less. David, really great to catch up with you as always. Hope to see you soon.
Thanks so much.
Thanks. The latest inflation numbers showing a rise in prices, setting up a tricky path for President Trump's promise to Americans about bringing prices down. Yahoo Finance's Rick Newman joining us now with more. Rick, indeed, we got 2 reports this week. wholesale and consumer prices, they're still moving up more than people expected.
And President Biden said, it's Joe Biden's fault. He called it Biden inflation. He put on social media Biden inflation up. And I guess you can give him a grace period here. The inflation reports we're seeing are for December and for January. That was the end of Joe Biden's presidential term. So I guess you could say we are getting the final readings on inflation during the Biden administration. But this is not going to last very long. That Trump is going to be able to get away saying this is Biden's fault. And meanwhile, we've got, everybody now is talking about eggflation. $10 eggs are the new $5 gas. It's that staple item that is shockingly expensive. Shoppers looking at that, and it makes inflation jump right to the front of their minds. And Trump has had almost nothing to say about this. I mean, if you just go back to last year's election, I mean, it's very clear from everything we know about exit polls and what was on voters' minds. They really wanted Trump to do one thing, which is get prices down. And so far, he just hasn't focused on that at all. Now, maybe he's going to get a break here. Maybe inflation will crack, pun intended, and it really will not be as much of a problem in 6 months or 12 months. But, you were just talking about those tariffs. Trump has already imposed some tariffs. So they're not just theoretical. He, of course, has threatened many other tariffs. We know from 2018 and 2019, tariffs did raise prices a little bit back then. There's less room for error these days. And consumers, again, surveys show that this is really on the mind of consumers. They do think inflation is going higher. So 6 months from now, if we have meaningful inflation and Trump is saying it's Biden's fault, I don't think voters are going to be buying it.
Well, Rick, you asked consumers how they feel about Trump's tariffs, right? You asked our readers. What did they have to say in the survey that you ran this week, and what were some of your top takeaways from that?
Our audience is pretty smart about tariffs. I mean, they understand correctly that tariffs are a tax that go on top of the price. They raise the price. And we asked, did you vote for Trump or Harris or somebody else in the 2024 election? And even among people who voted for Donald Trump, I think the number was around 45% who were saying, yes, I do think tariffs are going to raise prices. But what a lot of Trump voters said is, it's okay if tariffs raise prices because I think they're going to accomplish something that is going to make the pain of higher prices worth it. Now, only Trump voters felt that way. Among Kamala Harris voters or people who said they didn't vote, very, very small percentages said that any pain from tariffs is going to be worth it. And yeah, that's going to be Trump's big challenge here, assuming he goes through with this, whatever he ends up doing, whether it's tariffs for the sake of tariffs or some kind of negotiated trade deal. The burden is going to be on him to prove this is all worth it. And, we never got to finish that experiment the first time around in Trump's first term because of COVID. So we got some data because the tariffs went into effect in 2018. So we knew what happened for about a year or maybe a year and a half. And then COVID happened and disrupted all the, trade patterns everywhere. So it was very hard to figure out. Trump is doing more tariffs this time. He's doing them faster. So we're going to finish the experiment.
And you'll be tallying up all of the data for us, Rick. Thank you. Appreciate it.
Minute by minute. See you guys.
Coming up, Meta has closed in the green for a 20th consecutive session. We're going to hear from an analyst on the other side about how far the streak could last and whether you should be buying here. Stick around. Much more market domination overtime coming up. Oil closing its session slightly lower today. A host of factors are weighing on the sector as prices appear to be capped in the short term. For more, we're bringing in Yahoo Finance senior markets reporter Ines Ferre for more. Hi, Ines.
Hi, Julie. Well, some counterforces were in play today. You had some softer oil prices earlier this week on hopes that there was work being done towards a Ukraine peace agreement. But then overnight, you had reports that Russia had targeted a Ukraine nuclear facility. Russia denied that report. Also, you saw some volatility with oil prices today after Treasury Secretary Scott Bessent's comments to Fox, talking about getting Iran's exports lower. So that sent oil prices higher earlier in the session. But look, for the week, we're looking at a mixed picture. You actually saw WTI for the week that is down. This is a 6-day chart, but nonetheless. And then Brent crude for the week is slightly higher. The big factor still keeping a lid on prices is tariffs. The possibility of a full-blown trade war would put into question demand and economic growth going forward. Now, Trump is seen ultimately as deflationary for oil prices. You had JP Morgan this week coming out with a note talking about its unchanged forecast for Brent for this year, expecting Brent to be at around $73 per barrel on average for the year. Right now, it's sitting above that at $74 a barrel. And that's assuming that the Ukraine-Russia war will end this year sometime. Greater supplies next year would send Brent lower. So JP Morgan's thinking that there would be an average by the end of 2026 for Brent at $61 per barrel. Guys?
Ines, appreciate you bringing that to us.
Thank you.
Meta holding on to its record winning streak, seeing 20 straight days of gains. The company's record-setting run comes as Meta is reportedly planning an investment in humanoid robots. Here to discuss is Third Bridge Global Sector Lead, Scott Kessler. Scott, I want to ask you about robots, of course. Robots are fun. But Meta's up 20 straight days. I mean, what do you think is driving this? I know the street liked the earnings, but did they like the earnings that much for the stock to just sort of be a little bit of a number go up every day?
Yeah, what's interesting to me, though, is when you have a positive reaction to results and guidance, that typically takes place in the context of the next day or the next couple of days. It seems to me like folks are just excited about the long-term story and the valuation. And even though the work that we do at Third Bridge is mainly focused on fundamental work, it's hard not to kind of look at Meta and say clearly there are things that people like about the company and the stock beyond that.
Okay, Scott, but people like lots of stocks, right? They like lots of stories. This is really unusual action in terms of this 20-day streak. Like, what do you think is going on here that goes, it seems to go beyond fundamentals. I don't know what it is. I don't know how to explain it sentiment-wise, but I'm curious what you think.
So what I think is, here's a blue chip company that continues to deliver growth, notwithstanding the size of the firm and the ability to generate revenue. We're looking at expectations for revenue gains in the teens over the next couple of years and a PE multiple that I think is around 30 based on this year's estimates. That, I think, to a lot of people probably doesn't seem overly expensive, especially given a number of positives and perhaps upcoming catalysts.
So you think it has more room to run then, Scott, if we're not necessarily stretched from a valuation standpoint?
I mean, look, far be it from me, someone that hasn't really thought much about valuation for a while at this point, but it's fair to say that there's a lot of momentum here. I think there's a lot of positive fundamental underpinnings that people are interested in and focused on. You referenced the notion of the recent results, even if people think that growth is going to decelerate, and that seems to be the prevailing view. There are a lot of things to like about Meta, and I think people probably start with the AI story and the fact that that's not only been propping up a lot of the growth, but it's driving it higher, and perhaps that's going to continue for years to come.
And let's get to the robots then, as Josh promised. This report today that the company is investing in these AI-powered humanoid robots. There's no shortage of those investments around. Reality Labs has kind of been hit or miss kind of venture for the company. What do you think is the potential of this kind of investment?
Yeah, look, I mean, I think Meta is trying a lot of things right now. And as we were just talking about, I think the investing public is giving them the benefit of the doubt, which is kind of interesting on some level because they've had a number of what I would characterize as mixed successes at best when it comes to kind of certain areas within consumer technology. If you remember kind of the Facebook portal or the Facebook phone, there are things that they've done that haven't really panned out especially well. I think robots is something that's interesting. To some people, it's exciting. I would imagine it's perhaps most interesting and exciting to people within Meta, folks that are very talented, that want new kind of projects to work on. And so to some extent, this very well could be a way to attract and retain talent.
Scott, is it a reason to own Meta, though? Like, I'm thinking of Tesla, right? A lot of Tesla analysts would say robots are quite literally the reason to own Tesla, right? And sort of that autonomous story. Is robots and investing in robots really a reason to own Meta, or is it just something that you sort of watch off to the side and maybe hope that they don't invest too much money into it?
Well, I think the latter is probably more in line with what most people are thinking at this point. Reality Labs was referenced. It's 1% of revenue. Look, it's a $2 billion business from a revenue perspective, and I think growth is expected to accelerate from 13% last year to 15% this year. So it isn't insignificant, but when you think about Meta and all the different things that they're doing, I would imagine that what they're doing here potentially ranks pretty low in terms of focal points for the investing public at this stage.
Scott, what do you think the biggest risk is for Meta from here?
So there are a couple things that come to mind. Obviously, this kind of continuing land grab when it comes to CapEx and related spending, where it just seems like the numbers are going up and up and up. Meta also obviously is a leading provider of, let's call it, open source AI model offerings from Llama. And if we saw anything over the last month or so that's shaken the markets, it's been the kind of announcement and follow through related to DeepSeek, which people paid a lot of attention to, not just because of the cost and the capabilities, but also because of the open source approach. So that's number one, is just kind of the AI story and how that's going to play out, as well as the associated spending. We've seen in the past that investors initially have gotten excited about spending areas when I think about the metaverse in late 2021, and then people kind of change their tune very quickly when they realize that the growth story may not play out for the better part of a decade. So if there's any kind of disconnect in terms of spending and return on investment, I think investors could very well turn on their current view of the company.
Right, and of course then we saw Meta pivot as a result of that sentiment change as well. Scott, really good to see you. Thank you very much for your perspective. Appreciate it.
Thanks so much.
Time now for what to watch next week. Starting off on the earnings front, we're going to be getting some more big names reporting, including Etsy, Toast, and Walmart, the biggie. Walmart announcing results for the fourth quarter on Thursday before the opening bell. And analysts expect the retail giant will expand on its robust holiday season, driven by more engagement by higher income households.
Taking a look at the Fed, another round of Fed commentary coming in throughout the week. Wall Street will listen closely for any clues on the Fed's next move with interest rates. That's after Fed Chair Jerome Powell's two-day congressional testimony this week. Powell saying this week's data shows the Fed has more work to do. Also coming on Wednesday, the Fed is releasing minutes from the January FOMC meeting, providing more insight into the Fed's decision to hold interest rates steady.
And moving over to housing, a lot of fresh housing data coming out next week, including homebuilder confidence, housing starts and building permits, and existing home sales. Economists forecast existing home sales will come in at 4.13 million, a slight drop compared to December. From a hotter than expected CPI report to commentary from Fed Chair Jay Powell, it's been a busy week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
It was a crazy surprise. It was ridiculous. 0.5% month over month, folks, that annualizes to 6%.
Disinflation that we had been enjoying is now over, and unfortunately, we're not quite back to the Federal Reserve's target.
The economy is hot. Inflation has remained sticky, and that's well before the Trump administration introduced its policies.
We do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
So that really does push the timeline probably into the second half of the year if things go well.
I understand the concern Chair Powell has right now.
We just posted the best results of our history.
All in all, we were pretty pleased with how we came out of Q4.
Customer acquisition last year was absolutely phenomenal.
Hey, book your Valentine's Day ride out now.
Consider it done.
Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. A mostly muted day for markets, with the Nasdaq the only major index to close in the green, back above 20,000. We'll dive into the rest of today's market trends. Then buying a new home is already expensive, but new Trump tariffs could push that price even higher. We'll explore just how much of an impact new tariffs on aluminum, steel, and other materials could have on the homebuyer market. Plus, the next time you place an order at Wendy's drive-thru might not be a person on the other end. We'll explain in just a bit. Well, mortgage rates have been relatively stagnant for weeks, but our next guest says to be prepared for them to move higher, and it's thanks to President Trump's promise on new tariffs. Joining us now, Melissa Cohn, William Ravis Mortgage Regional Vice President. It's good to see you. So as we look at these mortgage rates, which obviously are a big obstacle for people in the market here, how does the sort of sequence of events work from tariffs to mortgage rates?
Well, mortgage rates are tied to the 10-year Treasury yield, and the 10-year Treasury yield really moves up and down with the rate of inflation. So anything that's going to increase prices and create more inflation in the economy is going to push the 10-year Treasury yield higher and push mortgage rates higher as a result. When the tariffs were first announced, bond yields actually went up and mortgage rates went up. The fact that President Trump has signed this big tariff plan, but doesn't plan to implement it until later this spring or early summer, has given some relief to the bond market. And we actually saw mortgage rates drop a bit this week, especially after the retail sales figure today. But the expectation is that when the tariffs do come into place and the cost of materials and goods is more expensive, that drives prices up, that drives inflation higher, and that drives bond yields up.
So let's talk about the backdrop, though, ahead of even the tariffs. As you said, many of them are not yet in place to affect the 10-year potentially. But in the short term, while rates may have dropped a little bit this week, there's not been much relief on that front. In the short term, do you expect there to be?
I really don't, because there's still so many unknowns. And if you look at the inflation data that we got this week, it shows that inflation is running much hotter than the Fed would like and moving away from the Fed's 2% target. So, the Freddie Mac 30-year fixed rate dropped a teeny bit this week to 6.87%, but we're still at 6.87%, which is close to 7%. We're not anywhere near where rates bottomed out last September at around 6%.
What about the volatility that we've seen in the 10-year? How does that tend to play through to mortgage rates?
Well, volatility makes banks tend to be more conservative in terms of their pricing. It increases the margin above the 10-year, that the spread that the banks place on a 30-year fixed. Volatility is a bad thing, just as inflation is. So until the volatility calms down and banks are willing to reduce their margins, that's going to also keep rates, inflated. Historically, the average spread above the 10-year Treasury for a 30-year fixed has been at about 1.75%. We're close to 3% at the moment, and that means rates are 1.25% higher than they could be historically if we had less volatility.
Melissa, there's also some reporting I've seen that there have been more people who are pulling listings, or who at least did at the end of last year, who had, they listed their houses, they weren't moving, and so at a certain point, then they pull the listing. Maybe they'll try again during the spring selling season. But it was an unusually high number. What does that signal to you, and do you expect those houses to come back on?
I'm a mortgage banker, not a real estate broker, but I think a lot of people did pull listings because they may be, locked into a low fixed rate. If you have a rate, it's at 3 or 4%, unless you can get a good price for your home. It may not be worthwhile for them to move on. And I think people are waiting to see what's going to happen to interest rates, in the economy in general as we head into the spring selling season.
And what kind of pricing pressure do you expect? I mean, obviously people, when they're buying a home, they're considering the whole price of the home, including the mortgage rate. So given that you expect rates to remain elevated, what happens then on the pricing side?
Historically, when rates are higher, values go down, but there's still plenty of marketplaces in this country where there are insufficient inventories to have sort of a still a normal running market, even though there are definitely more homes on the marketplace now. But I think the trend continues to be that the affordability factor is just too high, and there are too many people that can't get into the homes that they want to.
So I guess the question is, what causes an unfreezing, Melissa, and when could that potentially come?
Well, obviously, if interest rates come down, more buyers will come off the sidelines. More sellers will be willing to put their homes on the market because they will be able to get a lower rate on their new home. When does that happen? It happens when the rate of inflation starts to settle back down. We need to see the 10-year Treasury yield drop for mortgage rates to drop. It doesn't have to come from the Fed. Remember, mortgage rates are tied to the 10-year Treasury yield and not to the Fed funds rate. And we've seen, that mortgage rates really bottomed out when the Fed just started cutting rates. And as they continued to cut rates in through the fall, mortgage rates actually increased.
Well, we'll see what happens this time around. Thank you so much, Melissa. Appreciate it.
My pleasure.
Breaking news now, OpenAI's board is rejecting Elon Musk's $97.4 billion takeover bid for the nonprofit that controls OpenAI. The board deciding the bid, quote, was not in the best interests of its mission. OpenAI is not for sale, the statement read, and the board has unanimously rejected Mr. Musk's latest attempt to disrupt his competition. That was what Brett Taylor, OpenAI's chairman, said in a statement Friday on behalf of the board. Now, Musk and a group of other investors making that unsolicited offer earlier this week to acquire assets of the nonprofit that controlled OpenAI and effectively to gum up the works for that entity. Well, U.S. stocks closing mixed as the Nasdaq 100 logs its best week of 2025. Yahoo Finance's Jared Blucke joining us now with the trading day takeaways. Hey, Jared.
Yes, Julie, we got to talk about record highs. Didn't get it in the S&P 500, but that's the theme here. And the Nasdaq 100 is able to do it today. S&P 500 missed it by a hair. And here's the 3-month chart of the Nasdaq 100. And you can see that's a whole bunch of sideways, but we can draw kind of a little bull here. That's the way I'm seeing it. And here we have this breakout to fresh records just barely right here. But if you're looking at this, that's not a big breakout. This could still reverse to the downside, so we could still have some more consolidation. S&P 500 doesn't have to follow, but I think the price action from the week in other indices and other markets, especially the US dollar index, is very constructive. So let me put a line chart on here. Here's the 3-month chart, and you can see we fell here. We were here just a few days ago. Here is a multi-year high. That's what we don't want to see. And we are back down to about 8-week lows right here. And so that's very constructive for risk markets. You look at the 10-year T-note yield, another market you don't want to see go too high. That was down over the last few days as well.
So a little relief perhaps on that front. It is February.
Yes.
We're not getting any relief on the weather front, but what about markets? What does it mean for markets?
All right, we got a little bit of a cold water to pour on the markets right now. This is just potential here. So we're talking about seasonality. This can affect up to 1/3 of price action. If we have more controlling factors, we can see price do other things. But here's February, and you can see here is where we are right now. And for the rest of the month, we tend to see declines. And so this is a troubled month, historically speaking. Doesn't have to end up this way again, but I want to show you the whole year as well. And I have 2 different maps here, one in green, one in white, and I also have this year so far in blue. And what I want you to focus on here is this white map. This goes all the way back to 1928, lots of zigs and zags here, but for the most part, it goes from the lower left to the upper right. But where we are with this blue line right here in 2025, that's right before we tend to get some negative seasonality. So that's what I'm looking at right here. And that's taking back to the prior point. We have these breakouts in the Nasdaq 100 and some other markets, but do they get some follow through next week? Maybe not.
Right, but then eventually maybe they do.
Eventually, I think that, stocks go up. Stocks go up.
All right, let's talk about China, because there was some news flow this week. Alibaba and Apple, for example's new partnership on AI, but what were you watching?
Yes, well, last year it was all about stimulus, and this year it seems to be more about company fundamentals, which I think is very constructive. I'm going to show some charts here of China. I've been mentioning it week after week here because it has just been outperforming. It has been a market leader. Here is the 5-day price action. Number one is BETS. That's a gambling ETF, so that's not China, but FXI is, and this is pretty broad with respect to China. I'll show you the 5-year so you can see what happened within the pandemic. Last year, when we were talking about stimulus measures, I think that was this spike right here, and it was kind of short-lived because there wasn't a whole lot of follow-through. And as you can see, this peak in early 2021, that was when the whole world was trying to spend their stimulus checks in stocks and crypto. Well, that was the local high. I'll show you one more thing, Julie. This is a max chart. This goes all the way back to the early 2000s. China's a mean reverting asset. You could say this is a VIX chart. There's a huge spike here with respect to the global financial crisis, but for the most part, this thing is going sideways, and recently it's been going down. So I don't have high hopes for getting to record highs here, but I think we could make some material progress.
Interesting, a mean reverting asset. I
Yes.
like it. All right, thanks, Jared.
You bet.
Appreciate it. Well, coming up, have you used AI at the drive-thru? It could be coming sooner than you think. More Asking for a Trend on the other side. There's been a lot of talk about AI agents lately, but have you ever met one at the drive-thru? On an earnings call this week, Wendy's said it is expanding voice AI ordering to about 500 stores in 2025. And our next guest company provides similar technology for fast food chains across the country. Joining us now is Guy Lefebvre, CEO of Presto. Thanks so much for being here.
Thank you.
So how does this technology work, I guess, is the first question.
Yep.
Like, what's the experience if you go up to a drive-thru?
Absolutely. So a car pulls into a drive-through, usually when a human would come over the speakerphone saying, "Can I take your order?" That is AI. So a voice that sounds a little bit like AI will say, "What can I get you?" And then the customer will place their order, and then that automatically populates into the restaurant's effectively point of sale system. So then the computer is taking the order from that point onwards, and then we upsell during that process or potentially add things or take things away, and then the customer says that's all, and then it gets populated and it goes straight to the kitchen. So from the customer's perspective, it's not a huge amount different other than the voice sounds like a computer instead of a human.
Okay, so that's interesting because that's a choice to make it sound like a computer, right?
Yes.
Like you could make it sound more natural, but you want people to know that they're talking to a computer.
So a couple of years ago, yes, because when this technology was more nascent, it was actually quite important people knew it was a computer. Otherwise, they might get confused as to why it was maybe saying things in a slightly strange way. More recently, we have actually started to augment that with human voices because the technology is now much stronger. And so, after the Super Bowl, do you want to go with a famous player's voice instead of the computer voice? That's something we can now do, and we're seeing a bit more of that. And I probably expect that to migrate over the coming months.
So you guys are in some fast food outlets across the country,
Yes.
Carl's Jr. and Hardee's, and then some regional chains as well. Like, how's it going? What are people's reactions to this, both customers and the chains themselves?
Yeah, so consumers generally very interested and very supportive. It's still got that kind of cool edge to it, which is that I get to speak to a robot when I pull up to the drive-through. The actual owners and operators of the brands themselves are very happy as well for two main reasons. And in the context of where the fast food industry is at the moment, they get greater upsell because we upsell all the time. Humans will sometimes miss it. If you've got somebody who's busy in the store, we'll upsell continuously. And we can also help support bring their labor costs down, which given where labor costs are is very important because you can replace that person who is taking the order and have them cooking in the kitchen. And the overall system is just more profitable with AI in it.
What are the biggest pitfalls? I mean, I imagine, particularly when you get into dialect or people being far away from the speaker, that sometimes there are mistakes in the orders.
Absolutely. And so the industry has adopted something called non-intervention rate, which is the percentage of orders which are taken without a mistake, without the staff having to step in. Some of the biggest issues, and you've mentioned one of those, is dialect or regional accents, or actually also just Spanish as well. So where we have stores close to the border, which we do in California, we have had to develop a Spanish product, which is now in the field as well. But then when people switch between Spanish and English during an order, that can be an incredibly complex thing for the AI to take. We now have a solution to that, but that was something 6 months ago we struggled with a little bit, but we've now got much stronger. It's the variety of situations which is the biggest thing. No drive-through is the same as another one, and no customer is the same as the last customer. So what about the drive-through that's next to a highway compared to the one which is not, or where you've got 3 kids in the car shouting burger at the same time you're trying to place an order? Those are where the complexities come in, and the models are getting much, much better, but that's where we still have those edge cases.
Yeah, that makes sense. There's a lot of competition in this space right now, right? Both companies that don't specialize in drive-through specifically, who are just doing the voice AI, and companies that are specializing. So is it about the models being better? Like, how do you differentiate yourself?
The biggest thing is what you've actually just touched on, which is the specialism in the restaurant space. So Presto has got 15 years of heritage in the restaurant space. We're not just a technology company, and we actually understand how restaurants work. It's all very well putting in flashy technology into somebody's drive-through, but if you don't understand how to operate a drive-through or what matters in a drive-through, that's going to become a problem quite quickly. So the fact that we understand that means that we can work with operators. We find that's the biggest differentiation. The models is another point as well, absolutely. So we're LLM based, so we're based on an OpenAI equivalent. And we found that is much better for the complexity of a drive-through. I talked about the kids in the back of the car, the menus are continuously changing. If you're based on LLM, that model can learn with us and we can get some really good results. Some of our competitors have gone with an NLU-based approach or other technologies which are a little bit basically more rigid and they don't work in such a diverse environment as the drive-through.
So first the drive-through, then what? I mean, I know walk before you can run sort of thing, right? But what other applications do you see in the restaurant space for this kind of tech?
Yeah, so we're working on something at the moment called drive-through of the future. And that is, in our opinion, how these different nascent technologies are going to combine together to totally change the drive-through. So if you think about voice AI taking your order, add that to vision, maybe taking the number plate of the car so that you can also do loyalty. Add that to a robot flipping fries and flipping burgers, which is already in some stores in California. And then cameras maybe in the kitchen to check out flows and measure stock. If you were to combine that into an entire system, then that's a totally different proposition in terms of the level of staffing it would need, in terms of the consumer engagement you would have with it. We think that's what's next. So I'd be honest, we're not particularly interested in applications outside of the restaurant space because we're a restaurant company, but we think the next step is how we bolt those things together.
How far away is something like that? Seems kind of far.
The thing is, a couple of years ago, people thought voice AI was kind of far, and then the amount of progress over the last 8 months has been absolutely incredible. I think we're talking 24, 36 months before we start to see some of those all together. It's really not that far away because the individual pieces are there. It's just knitting that into a seamless experience, which is the last step of the process.
Interesting. As I was saying to you in the break, I'm not a drive-through girl, but this makes me want to go and check out an AI drive-through. Guy, thank you so much.
Thank you very much.
Appreciate you coming in. Coming up, we're looking at NVIDIA's portfolio reshuffling in our chart of the day. We're asking for a trend on the other side. We learned today how NVIDIA had reshuffled its portfolio. For our chart of the day, we're looking at the effect on the different stocks involved. Yahoo Finance's Josh Schaefer joining me now with a closer look. Hey, Josh.
Hey, Julie. Yes. So we are looking at the companies that NVIDIA either bought more shares in the last quarter or sold some shares in. And what I think the key sort of takeaway here is AI euphoria is still in this stock market. People are looking to chase some AI trades if they think that it has not been fully priced in and investors haven't really piled in yet. So NVIDIA bought shares of WeRide, which is a Chinese autonomous driving company. That company's stock almost doubled earlier this morning. You can see it came down a little bit here. This is about as of 12:30 this afternoon. Now, NVIDIA also sold shares in SoundHound and sold shares in Serve Robotics. Those companies saw their stocks fall about 30%, but it sort of raises an interesting question for investors, which is we used to chase maybe what Warren Buffett was buying or what another famous investor is buying. Should we now be chasing what NVIDIA and Jensen Huang are buying because of how good they've been at AI? We asked Tom Sosnoff, the Tasty Live founder and CEO, that question earlier today. Let's take a listen to what he had to say.
But for me, the opportunity would be to, that's a classic buy the rumor, sell the news. And I think in those cases, when you see a stock that shoots up on somebody else's news and you have to kind of wonder about the integrity of that news, then I think it's much more of an opportunity to sell into it than it is to buy into it.
So Sosnoff laying out there that he doesn't really think trying to chase this SEC filing that NVIDIA filed, and it actually tells us what stocks that they owned several weeks ago, not what stocks they own today. So in theory, the company could have moved those shares, Julie, in the last couple of weeks, and so we don't even really know exactly what the holdings are at this precise moment, and perhaps the overall investor takeaway just being 13F filing is a little bit of yesterday's news to be chasing tomorrow's trade, but at least shareholders of WeRide had a pretty solid trading session today.
Yes, it does seem that way. Thanks, Josh. Appreciate it. And that's a wrap on today's Asking for a Trend. Be sure to come back Tuesday. We're not here on Monday. Markets are closed. Tuesday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night and a great weekend.